Okay, good afternoon, everybody. For those of you that joined us on the Asian Equities Update webinar, welcome back. For those that didn't or couldn't make our other one at midday this afternoon Sydney time, you received an email with the recording anyhow, so please feel free to reach out. So let's jump straight into emerging markets update. So to give you a bit of context now where we sort of stand with emerging market debt, we've hit a lot of new milestones in the last 12 months. We've taken a sort of a more active approach to taking advantage of the environment, which is COVID-19. And I'll sort of run through that. It's been very, very interesting and very, very rewarding to investors. And over the last 12 months, to also provide everyone with a bit of context, news just came out this morning and stated that there's been $7 billion in new fresh flows year to date from offshore funds into Chinese bonds this year. And the thirst for yield has never been stronger. Especially even locally here in Australia, our reserve rate's down to 0.1, and as I understand it, for our friends over the ditch in New Zealand, your reserve bank is looking and considering negative rates, and obviously what that might entail for investors going forward. So let's jump right into it. Standard disclaimer. So this is what the world looks like for us in terms of opportunities and risks. Obviously, there is the continual Sino trade relations with the US and somewhat so with Australia. So feel free to ask questions that are investment related, of course, in the question box you see in the panel on your right hand side. Obviously, we see a lot of concerns around the debt market. March provided a very big reset point for a lot of investors. Again, it had very little to do with credit risk and had everything to do with liquidity. And effectively, a lot of people were very, very concerned around not being able to get out, and sort of rehashed a lot of what happened during the GFC. Our CIO, Gordon Yip, his very simplistic but very effective way of describing what happened in March this year was effectively saying, we saw the liquidity come out of the system in the same way that Lehman Brothers collapsed, or the lead up to Lehman Brothers collapse, within a 48-hour period. Okay, so liquidity dried up. What took over a year to do during the GFC took 48 hours in the COVID crisis. So it was very, very interesting to watch, and that provided us with a lot of opportunity to sort of de-risk our portfolio, but also increase the overall return profile to your investors. So just a quick update, Value Partners, our managers, excuse me, based in Hong Kong, now manage about 12.5 billion in total FUM, of which 8 billion is equities and 4.5 billion is fixed income. And we have our 70 investment professionals on the ground looking for investment opportunities. Biggest team in the world, looking after a single region. We do not profess to know anything other than investing in Asia and to a certain extent emerging market debt as well. So one of the key things that we say is find specialists in a world where rates will remain low for a very long time. Seek out active management. Bonds is the most challenging sector at the moment. Bonds are very expensive in Western markets. So, the key thing I say is if you buy an index bond exposure now for your clients, and unfortunately, being very frank, as many of you know I am, advisors unfortunately do not understand how debt works in a broad case, because the amount, and this is represented by the amount of flows we're seeing into index bond strategies, is astounding and also very concerning. If you use a backward mirror to look at bond strategies, it gives you no guidance as to what the future looks like, especially as interest rates has effectively structurally come down in 30 years. And then that has brought about a lot of capital gains. But we're sort of at that point now that if you buy, let's say, an index Australian bond fund, you're basically looking down the barrel of buying a portfolio of bonds that cost you about $115 a bond. In 7 years' time, you'll get back $100 and you'll get paid about a 3% yield. Net, you effectively get paid about 0.7 of 1% per year in total return, but you have to face your clients and tell them that they're going to lose 2% a year on their capital value. That's because rates have come down so much. So be very, very careful in terms of how you allocate to bonds. Very, very dissimilar to how you would consider equity investments. So we still have kept up across our team of 70, 6,500 company visits. Not very difficult given the fact that we have over 70 people, and therefore on average we're looking at just under 100 visits per person per annum. One-on-ones, not broker research visits. We continue to expand our fixed income investment team, and probably what's going to be interesting and sort of flagging that out to everybody here is Lily Howe has been a great asset to the team. She is in charge of onshore debt. So as many of you know, that investment strategy on behalf of your clients, 100% of our debt at this point in time is offshore, all denominated in US dollars. We are considering utilizing a small portion of our portfolio going forward onto onshore debt because there's sometimes an arbitrage opportunity. So a corporate may issue debt onshore as well as offshore, and there's an arbitrage opportunity that we may take part in, and that will add some value to you, but it definitely won't be sort of more than around 5% of the whole portfolio. Something that we're very, very comfortable with. We also have Alvin So, as you can see on the screen there. That's legal counsel. One of the most obviously important things around debt structuring is the ability to understand exactly what legal levers one has as an investor or as a business in terms of levels of recourse, how do you actually get your money back, what happens if you miss coupon payments, ramifications of that as well. So Alvin has also been a very invaluable resource. So our team has grown now to a total of 11, very, very strong covering the ground there. So sort of recapping of what we're trying to achieve for your investors in this portfolio. Primarily, we are invested in high yield. Leading up to March 2020, it was effectively 100% high yield, but that's changed, which I'm going to go into a bit of detail because it is very important for everyone to understand why we've sort of changed tact, and sort of again represents how active we are in terms of portfolio and basically trying to find the best value for you. The strategy is around $50 million. It's been growing quite steadily because many advisors have sort of seen the light with our strategy and sort of over many years looked at it, considered it, and finally have pulled the trigger, which is great to see. And our family still maintains our $5 million investment in the strategy. So it's done very, very well for all involved. So high yield is the predominantly what we're trying to do. We have some investment grade, which is what's increased in the last year due to COVID. And then we run special situation over the top of that, no more than 67% of the portfolio at any given time. I will give you two examples, one that's already completed, one that's actually live and hasn't been actually completed to final value yet. So I did get compliance clearance 2 days ago to actually talk about that. It was quite a bit of a battle, as you can probably understand, but I did get it across the line, so I can share actually a live thing that we're doing right now. And then what we then overlay that is we have active hedging. So given the fact that our entire portfolio is US dollar denominated, we can actually use the hedging between Aussie and US dollar to reduce the overall volatility of the fund for your investors. That's why you would see year in, year out, we've kept the vol of the fund under 600 basis points, which is fantastic given, you know, ultimately the market that we're invested in can be volatile at certain points in the cycle. So sort of to give you an idea of how that hedging has worked out for us, in March when Gordon sort of saw, you know, a very, very significant risk off event happening, in a very objective way, he said, okay, Aussie is very much a risk on strategy, risk on currency. If everyone's, you know, happy, markets are buoyant, not much global macro happening, and, you know, especially China keeps taking in our resources, Aussie dollar remains reasonably buoyant. But in a, you know, Delta One event like we saw with COVID-19, and as the Aussie dollar started to sink, Gordon basically took off all the hedges at sort of close to 70 cents and rode it all the way down to 55. So basically, in March, while the mark-to-market value of our portfolio went down 15%, which is in line with the rest of high yield, we managed to shield effectively half of that with being 100% unhedged, which meant that in March, our portfolio only dropped 7%, a fantastic outcome, and we outperformed many even half investment grade, half high yield funds in our universe available in Australia. So we're very, very proud of what we've achieved for you and for ourselves, of course, during that period. Then from March, Gordon saw that, ultimately this is a very, very low point, and on an average entry price of around 59 cents, he hedged the portfolio back into Australian dollars to about 60–70% and rode that all the way back up to 70 cents, again reversing the impact of currency on the portfolio. So therefore, that's why you've seen such a steady appreciation of the overall fund. So we don't put our finger in the air, of course, and just randomly pick bonds to add into our portfolio. We do underlying credit research. That is our key component. The way that we add value is that we ignore what everyone else does. We do not care about what external research houses say. It is completely irrelevant. It means that our universe is larger than your average bond fund. It also means that we are willing to do the work. Therefore, it is a very, very high cost in labor intensive exercise. And when the team adds a particular bond into the portfolio, it sits into 3 buckets. As you can see here on the slide here, it either sits in the capital appreciation, income book, or tactical trading. Okay, so tactical trading is usually our sort of special situation book. Income book is something that's going to stock standard pay us a great income, and capital appreciation is buying some value names. So bonds are trading less than $100. We're going to make good capital gains on top of that, as well as the income that they're paying. And you can see that when we rank every single bond, you can see that from here, based on fundamental score, risk reward score, and liquidity momentum, depending on what we actually want to achieve and how we want to win in that bond, will then determine the weight of each of those scores. We will never invest in anything under 4, and ultimately this is our sort of credit scoring table to give us as much both objectivity and subjectivity in the sense of an analyst or a fund manager picking the bond. So if I sort of look at this particular example, this is a property company here. The fundamental score is made up of 80% of data that feeds through from Bloomberg, and then 20% is the analyst or fund manager that's sponsoring it, and their view on the quality of senior management and how high the conviction level is investing in that particular bond. So depending on how that works out, it has that particular weight and ends up spitting out this score. So everyone's desperate for yield, whether or not you want to or not understand or deny that rates are really low. Clients are in desperate need for income, and the level of income that's produced from traditional instruments literally cannot cut it now. And under any sort of measurement benchmark, once you take away your fee, platform fees, admin fees, your clients are all in negative territory in traditional income products. So your choice is either you're going to double down on equities and go equity income. You're going to go for alternatives, which we've seen during COVID-19. It was alternative funds have basically underperformed everything. Very, very disappointing. Some groups that we're working with have completely removed alternatives from model portfolios as well, solely because you just couldn't explain what had happened to that point of the market with your clients. So if you consider how desperate people are for yield, effectively what you see here is that less than 5% of the world is paying 5%, okay, or more in terms of yield. And if you sort of look through the sort of mustard color here all the way to green, this is under 2%. So 80% of the debt available in the world is paying less, this is corporate and government put together, is paying less than 2% yield, okay? Then if we could take a comparison between investment grade US investment grade and Asian investment grade, what you see here is that there is still a spread of around 53 basis points. So investing in the same equivalent investment grade debt in Asia, so just as the JP Morgan Asia Credit Index, it's basically come from this top point in March when everyone was desperate to get out. It's retraced the spread about 60% of the way, and then it's still getting a 53 basis point premium against the equivalent IG US corporate debt. If we then look at high yield, a much wider story here, you're getting about 141 basis point premium there. So this is across the broader market. And it's retraced 2/3 of the spread blowout that we saw in March. All funds up until now, obviously since about May through to July, depending on the type of strategy you're in, all these sell spreads have been brought back into normalized conditions. We participated in that as well. We increased our sell spread solely to protect investors. We did that. We removed or reduced back the sell spread on the 1st of July. And investors and advisors were very, very supportive of that move, solely to protect your clients' interests. In terms of where we sit with performance at the moment, the figures on the left-hand side, we managed to get clearance as of this morning to release our November figures, so literally a couple of days old. We're tracking at about 5-ish% for 6 months and around the same for 1 year. So taking into account that one blip that we saw in March of negative 7%, and the funds retraced all that back plus more over this period. So sort of if you look at your 1 year chart, you're still up sort of 5-ish%. Annualized volatility, even inclusive of COVID, we've kept it again, still very, very strongly below 600 basis points, and total annualized return is around 9.5% net of fees. And that's inclusive of the fact that from memory 3 years ago, we consolidated our fee on this strategy as well, removing performance fees. Now, what is more important that I want to sort of talk through now is the way of the portfolio makeup. So for those of you that have been following the strategy for at least 5 years, you would have always noted that our cash yield sort of sat around 7.5% to 8%, okay? And that's come down. That's in line. There's sort of two factors. One is market rates have come down, obviously, and that's just every fixed income fund across the world, even in mortgage fund land, that's still the same situation. Rates have come down. The second part of it is our reset in March with regards to COVID and the way that a lot of debt reset their pricing. What I mean by reset is you had a lot of investment grade debt effectively get sold off very heavily to the point where our team basically said, we can actually buy investment grade debt, senior debt, of course, at high yield prices under a normal set of conditions. So what do we mean by high yield prices? We're talking about the actual discount against its par value of $100. Okay, so remember, what we're trying to achieve is we're trying to say we're going to get you 6% distributable yield per year, plus a little bit of capital gains. And the capital gains is achieved by buying bonds at less than $100 in value. So this is where the yield to maturity comes into play. The cash yield is defined by all the bonds in our portfolio, assuming they're all at $100 par. What's the yield you get? So assuming everything is trading at $100, you'll get 6.82%. Okay? This is pre-fee though. Okay, so to be very upfront. Okay, so this is pre-fee. The yield to maturity represents the cash yield plus or minus the amount of capital gains you'll get depending on where your portfolio is trading in terms of market value. Then we've got our average time to maturity, which is about 3.6 years. So this is what we're saying. For the next 3.6 years, if we continue to hold these 54 bonds and won't sell or buy anything new, which obviously won't happen. So this is always data at a particular point in time. We'll generate 6.82% in cash yield plus just under 200 basis points of capital gain per annum for the next 3 years, okay, or 3.5 years or thereabouts. The problem that most bond funds face at the moment is that the yield to maturity is actually lower than your cash yield. And that's the problem. If you have a yield to maturity lower than your cash yield, it's the opposite. You will make a capital loss every year leading up to the maturity of those bonds. That's the danger in looking at previous performance on bond funds. All the bonds that we buy are fixed rate. So therefore, as rates have come down, we haven't directly been impacted by that. But our cash yield has gone sub 7 because we bought investment grade debt for the first time because the opportunity was basically a no-brainer. The credit ratings you see here on the bottom left. So for the entire history of the fund, you basically never saw triple B or A level debt. We are now holding 22% investment grade, with the remainder being high yield or non-rated. And the way that the portfolio has been structured as well is that the triple B and single A debt are debts with long dated maturity. Okay, because for those of you that understand better or more about how bonds work, the closer you are to the maturity of that debt, the closer it will be to $100. But at the same time, if you have a Delta One event like COVID-19, what you will also see is that investment grade debt will trade at a more steady value. It will still get sold off, but it will get sold off in a less sharp manner compared to high yield. Which means that if you are holding a long dated investment grade piece of debt, it will trade more steadily. If you're holding a high yield debt with a long dated maturity, it will get sold off very sharply. If you hold a high yield debt that is short dated maturity and it's getting pretty close to its maturity, it will also trade closer to $100 despite having a Delta One event. So we've taken a barbell approach with the way the portfolio is managed. So we're holding 22% in investment grade debt, which is long dated, to reduce the vol if we see any other macroeconomic shocks. And then with the high yield debt, we are holding it in shorter dated maturities to also reduce overall volatility to the portfolio. Our real estate exposure has fallen below 50% as well. That's to accommodate the investment grade debt, not because we don't like property anymore. And for those of you, again, who have followed the strategy for a while, we are very, very happy to be invested in the property sector solely because of the fact that it has the best realizable value. It has third-party independent valuations on land and property. And third of all, it gives us a much better idea of cash flows and realizable value compared to many other industrial companies. And at the same time, because of the same first in, first out type scenario with China, with regards to COVID-19, our exposure is 75% in that space as well. So this sort of also solidifies the reason why we are very happy and continually positive on being in property developer bonds. Since May, what you've seen is that every month there has been more sales of property compared to its same comparable period in the previous year. Okay, every month it's registered better sales figures. Okay, so therefore, at the end of the day, what our biggest concern is the cash flow of developers. And if the cash flow is strong vis-a-vis selling property, we are very, very comfortable in continually holding property bonds. And ultimately, property also remains a key driver as to why the Chinese government wants to support it. And what you don't see in China compared to other Western countries, including Australia, is that wage growth is actually, in most cities, higher than property price growth. One of the biggest issues that we have is if you have wage growth that is growing slower than property prices, property becomes more and more unaffordable. And that's causing big concerns to a lot of people across the world. But from an investment perspective, we're still more than happy to invest in Australian property, US property, so on and so forth. And then, if that's the case, investing in Chinese property developer names in a market where wage growth is growing faster than property, therefore creating more affordability and therefore re-represented in very strong property sales that you see on the chart here, it's not concerned. It's not a concern of ours. Then let's talk about distribution updates. So you would have noted, for those of you invested at least since the fourth quarter of 2020, you would have received a 6% distribution, or your clients would have received a 6% distribution. That was mainly due to those two hedging movements that Gordon had over the course of the financial year, one in March, and then the other one actually literally on the 28th of June. Just recapping, how trusts work. Ultimately, if we have any accrued income / capital gains in the portfolio ending 30 June, we have to pay all that out and flush it out. So for the financial year, the 4 quarters put together, investors received 10.5% in distribution. And we've maintained another 1.5%. We have never, ever paid less than 1.5% per quarter since the inception of the fund. So that's been a very, very strong attractive point for investors looking for income. So I want to cover off two special situations, that one that's live, one that's already happened. So this first one is Israeli sovereign debt. So Israel is actually our most furthest geographical available country that we can invest in on the Western side. So Israel have been issuing some sovereign debt, which sort of piqued our interest because it's paying on face value 3.8%. But they're issuing 40 and 50-year bonds. We were concerned, not concerned. We were very excited because when they issued the 50-year debt, what you saw was that basically within a week after its primary issuance, it jumped 7% because everyone's really desperate for yield. So if it goes up 7%, then your actual yield, your 3.8% sort of gets closer to becoming sort of 3.4 or 3.3%, and investors were happy at that level. So a month later, at the end of April, we found that this looks really, really interesting. And anchored by Taiwanese investors, we decided to follow suit and said, you know what, a 40-year debt and a 50-year debt of a sovereign makes absolutely no difference from an economic outcome perspective. No one knows what's happening, 30 years from now, let alone 40 or 50. So therefore, if simply a month ago you had the 50-year debt trade 7% up in capital value in the course of a week, we believe that if they issue more debt a week later or a month later, it'll do the same thing, and that's exactly what happened. So this didn't really fall into the special situation in terms of distressed, but this was a no-brainer, absolute no-brainer to us, and this is the power of active management. We made 7% capital gain on the bond, not interested in the yield at all, in a week, and sold out. Now, this is a live one. As I said before, I got clearance from compliance to talk about this because this hasn't been repaid yet. But in light of the fact that no one could actually participate in this bond anymore, I'm allowed to talk about it. So this is Yuhuang, which is a chemical company inside China, and its underlying debt actually defaulted in March this year. So defaulted in the traditional way and was unable to repay its principal. Okay. Then a restructuring proposal went public in October 2020, and that's when that piqued our interest. So we're always in the market looking for this, okay? Just like our equity funds, we are bottom up, okay? Bottom up in investment for us is that we will find any bond where we believe that we can make a great return on. Whether it be equities or fixed income, Gordon always has a great line, and he says, Jonathan, there's no such thing in this world that's called a bad investment. There's only a bad price you pay for an investment. If you are selling me rubbish, if you are giving me a price that's lower than rubbish or almost giving it to me for free, why would I not buy it if I'm taking measured levels of risk? Okay, in the same sense, a great company that is trading at a significant premium is not attractive to me. It is not a good price. It might be a great company, but it's not a great price. So with Yuhuang here, our investment team sat on the company's ad hoc bondholder committee. Okay, so we were very heavily involved throughout the restructuring process. And what we tried to do was, how do we actually recover the money? Because the bond went from sort of, $80, and then people started to get pretty freaked out around its ability to repay, and it got to sort of got to a bottom at the beginning of October when its restructuring came out. It got down to $20. Okay, and then so we decided to jump on the bandwagon after we did our further due diligence. So we worked out that the company in the United States has a large methanol plant where the underlying company owns 40%. Okay. We then managed to bring the company, local government, and a co-investor of the USA assets, so the guys that own the other 60% of the methanol plant, to the table to strike a deal. So we felt comfortable that after they struck the deal, obviously the price of the bond went up. See, you can criticize us and say, well, if we knew what was going to happen, why didn't we buy it at 20 and then we're looking at exiting at 62? We would have made 3 times our money. But we weren't comfortable at this point because we were not at a point where we brought these 3 guys together to strike a deal on the restructure and have a new charge over this asset. So after the deal was struck, we bought it at $52.50. We expect that by the middle of December, the asset will be completely sold down, partially funded back, and we'll get our and we'll sell. We'll get 62 cents in the dollar back. Now the reality is those people that invested at the beginning will have lost 38% of their money. Okay. But in our situation, we're buying it at that distress level, at a restructured level, and we expect by the middle of this month, this will be done and dusted. This is a great special situation example here. This is where we sit now with our return versus volatility chart. We're achieving less than 6% in volatility, but our total return is 9.5%. This is of absolutely no bearing in terms of how you should look forward with fixed income investments, because these 9 years we have seen interest rates come down, not up. So in a market where rates have come down, and if there are funds here within the universe that are generating less than 4% in total return to your clients for the last 9 years, what is it going to do for the next 9 years in an environment where rates cannot actually foreseeably get any lower, unless we're going to go into deep negatives, which creates obviously a whole bunch of other issues. And just to cover off drawdowns on our strategy, you'll note here that our best time periods, I mean, best, everyone sort of understands that, but what's our worst? Our worst is COVID. Okay. Our worst 1 year was one of the restructuring, sorry, not restructuring, but one of the onshore, offshore debt issues that we had in the market during this period here. And the worst 3 years we had, we generated a total of 4% inclusive of COVID. Okay, so that was our worst 3 years ever in the strategy. And relative to our peer group here, this is the Morningstar direct data ending October. Obviously, there's no November data out yet. We sit sort of pretty much top quartile, or in the case of 5 years, we're talking like top 1% of the world. And on top of that, SQM has upgraded our fund to 4.5 stars. I think it was 2 months ago. And that's after 5 years of research, consistently upgrading the rating, and it makes us the single highest rated bond fund, global bond fund. They have a domestic bond fund that's 4.5 stars, but we are their only international bond fund that is rated at 4.5 stars. Our upside downside capture is also incredibly strong. Our upside capture against Barclays Global High Yield, we will outperform the benchmark 80% of the time. And then on the downside, we'll capture, 80% of the upside of the times when markets are going up, we will outperform Barclays Global Ag. And then when markets are negative, we will only fall more than the benchmark 30% of the time. Okay, so that's an upside downside capture, which is incredibly strong. And this is, we're edging sort of closer to 10 years. We're now at about 9.5 years track on this strategy. So the outlook for Asian bonds, the last 2 charts here. The market is getting very, very big. There is a lot of foreign interest. And Asian credit is now worth more than $1 trillion, comparable with the size of the US high yield market. Post the Asian financial crisis, Asian countries and capital markets have further developed very strongly, and therefore that's why the bond market has opened up. Now, the reality is that if you want to invest in Asian bonds, 60% of the market is actually China, Hong Kong, Macau. So it's not a matter of whether or not you want to avoid it. It is the part of the market that takes up the lion's share. And since April 2019, Bloomberg's Barclays Global Ag added China onshore bonds. Okay. And that's going to be very, very interesting. And that's why we're also very interested in onshore bonds going forward, to sort of see if there's any dynamics for us to arbitrage as well. And Asian yields compared to developed market yields, as shown by the 2 spread charts I showed earlier, continues to be a very attractive entry point to the fund. You'll get a copy of these slides after this, as well as the recording if you want to share with your colleagues. There's one question here that says, is the fund overexposed to property in China? I think I've already answered that question. No, solely because of the fact that historically we've been 60% allocated to Asian property. We're now sort of 43%, so therefore we're not. If you look at the whole the Greater China bond market. In actual fact, about 65% of that market is actually property. So it is an area that you're just not looking towards. And as I said, this whole constant battle that people have psychologically, in our opinion, that's saying that Chinese property is a basket case. We just don't understand why. As I said before, Australian property is a basket case because people are finding it more and more difficult to afford property. That's not the case in China. And this whole thing about showing different cities and then showing empty apartment blocks, yeah, that they are true. We've never denied that. That's why you need active management to find those that are. You can go to Western Sydney, for example, and find plenty of apartment blocks that can't be sold. South Brisbane is another great example. That doesn't mean the whole market is completely completely fake, or that the market's going to blow up. So active management, whether it be equities or bonds in this current environment, is critical to the success of building your client portfolios. And with that, I'm happy to take any other questions. We're sort of 6 minutes over. I promised everyone I won't be too long-winded. Is there any other questions? Okay. If that's the case, I wish everyone a wonderful festive season. We plan on running monthly webinars, one on equities, one on fixed income every month starting February. We're going to keep it short and sharp to these 30 minutes so that people don't get zoomed out. And please stay tuned. And for anyone that has any further questions, again, you've got details up on the screen. Please feel free to reach out to us. So thank you and have a good afternoon.